Good morning, everyone. We have quite a few folks joining us right now. We'll give it a couple more seconds and then we will begin, Lou.
Okay, thank you.
Feel free to say hi or introduce yourselves in the chat box so we can all just say hi. Hello, Victoria. Good morning, Bruce. Hi, Paul. We have Paul from Central AZ College, Lou, here with us.
Excellent. Hello, Paul.
Hello, Jennifer. Good morning. Good morning, Anna. Good morning, Kevin. Hello, Jane from Sawarita. Thank you for joining us. Have a couple of our business analysts here on the call. Feel free to say hi to them. Alrighty, Lou, is this a good time for us to start?
Absolutely. Let's go.
Awesome, it is go time. Well, hello and welcome everyone to What Are My Options? Alternatives for Financing Your Early Stage Venture. I am Eileen Villa-Golden, the Maricopa SBDC Program Analyst, and I will be facilitating the webinar. I will be monitoring the chat throughout the webinar. So if you have any questions, please feel free to put your questions down in the Q&A. That way they do not get lost in the chat. As I have mentioned earlier, if you are just joining us, please feel free to put down a quick introduction, your contact information. That way, if anyone would like to network or connect with you, they have your information there. I would like to introduce our speaker, Lou Farina, who is one of our amazing business analysts and our presenter. And I want to thank you all for joining us today.
Hello, everyone. Lou Farina from the SBDC, and welcome to this webinar. Thanks for spending some time with us this morning. We've got a lot of material to cover, and I think it's going to be an interesting webinar. The topics for today, what this webinar is going to do, and I'm going to tell you, this is the first time I've done this webinar, and some of you may have been on some of my webinars on angel investing. We do a fairly deep dive, but you know, day to day with our SBDC and our counselors, we talk to our clients about a lot of different options, and so I was asked to put together a webinar that really kind of talks to the different options. And you know, when you go through it, there's lots. And so what we're going to do today, we're going to try to cover all these topics. It's going to it may go a little bit long. It's kind of lengthy, but we're going to try to go a mile wide and maybe not an inch deep, but maybe a foot deep. And then we're going to try to save some time at the end for questions. We'll see how much time we have at the end. We probably could go over a little bit, and it's not a problem for Eileen and I. So let's see where we are. So with that, you know, if you're on this webinar, you're probably interested in raising money for your venture. It's tough. There's a lot of options. Where do you start? The topics for today are listed here, self-funding, friends and family, et cetera. We'll go through all of them. What's not on this slide is we're going to talk about debt in addition to these particular other options. What we can do here is, let me introduce myself first. I'm sorry. So Lou Farina from the SBDC, a business analyst. I specialize in technology commercialization. I'm a formerly tech exec. I've done a lot of corporate ventures. I've been in mergers, acquisitions, divestitures, turnarounds on a global basis, large scale corporate investments. I've served as a strategic advisor, consultant, angel investor here in town. I was an SBIR reviewer for the National Science Foundation. So I got a lot of background to help you with these different areas, as do many of our other counselors also. Let me just do a quick plug for the SBDC, let you know who we are, what we do, how we do it, and then we're going to do a poll real quick to get a sense of who's in the audience. So, you know, the SBDC, the Maricopa SBDC is part of America's SBDC network. So it's a national program, a national network, partially funded by the SBA on the federal level, but matched and sponsored by the Maricopa Community College District or the many community college districts in the state. Ours is Maricopa. There's 10 different centers in the state. Maricopa is by far the largest, so we've got a cadre of counselors. I don't know, we're down up to 10 or 12, but if you go anywhere else in the state, you can find resources, SBDC resources and counselors to help you. There's offices in Show Low and Flagstaff and Prescott, Harvey, etc. But really, if you go any place in the country, there's an SBDC resource set up to help you. So you can go to a different state, and there's a program in every particular state. So what do we do? And at some point, we're probably going to change this slide. So at the top of it's disaster loan assistance. When I first started here, it's about 3 years now, we didn't do that, but now we've done a lot of it. And a lot of you folks know us maybe from helping you with your PPP or EIDL. Those programs are sunsetting. We've done a lot of it. We continue to assist some of our clients, but we move into our more traditional areas now. Lender readiness, if you need a loan, this is where you come for assistance in putting your loan package together. We have specialists doing financial reviews, marketing assessments. We've got some folks doing buying and selling businesses, manufacturing, myself in technology commercialization, export and international trade, as well as government contracting. And the government contracting is through a sister group called PTAC. And if you're interested, we refer you for those folks. You can work with both of us. So what we do is counseling. We call it counseling. It's advising, you know, it's a one-on-one advisor assigned to you. We are advisors. We're not necessarily consultants in the fact that we really don't do a lot of work for our clients. We review their work, we advise, we provide resources. We've got many different tools that we could provide to you, actually no fee tools. And then we provide training also. And this is part of our training series. You'll probably see, I don't know if you've looked at our calendar, but there's many, many more programs coming up here in the near future. So that's it about here's our website. I'm sorry. Here's our website, Maricopa-SBDC. So right now we're going to do a poll. And Eileen's going to put the poll up, and it's which vehicles have your company used to attempt to raise capital. And so you can, I think the poll set up where you don't have to have raised the capital if you've attempted, and you can pick multiple areas. So just fill in. This will give me a good sense and us a good sense of who's out there and where you're interested. And when you're done, Eileen will present the findings.
I will give it a couple more seconds for everyone to fill out the poll. Alrighty, Lou, our Our number one is, of course, self-funding. And next we have friends and family.
Is there any way to flash the results up on the screen? Or do you need?
Yes.
There you go. Okay, a lot of folks funded it themselves, which I'd expect, friends and family, some crowdfunding, grants, SBIRs. Okay, good, excellent. So, sounds like the folks who are self-funding are looking for other vehicles, and you're in the right place. So excellent, thank you, Eileen. Okay, so I'm just gonna give you a quick overview of kind of from an equity perspective, there's kind of a progression for these potential avenues or vehicles. So in the idea stage, initially it's self-funding, and then we always joke, what's the second money in? It's always yourself. So lots of self-funding. Pre-seed, I would call friends and family, crowdfunding, accelerators, competitions, grants, SBIRs, and we're going to go into all of these in more detail. When you get into the seed, the startup, you're talking about angel investors, maybe strategic investors, and then you can start to talk to corporate venture or venture capital, and then you get IPO private equity. We're not going to touch IPO private equity. We're going to get up to like venture capital today, but usually like the idea is, angel investors typically won't talk to you until you've funded yourself and maybe you've had some other avenues or other vehicles funded. And then, after angel investors come in, maybe corporate venture will talk to you, maybe venture capital will talk to you, but there's typically a progression. It's not 100%, but it's typically how it goes. So we're going to talk about these individual items. And the first we're going to talk about is self-funding. And one of the things I also want to say is that the way I've kind of constructed this webinar is at the end of each of these, I want to talk a little bit about the pros and the cons, because it's not every vehicle is right for everybody at the right time. So we should be aware that there's some good things and there's some things to kind of not necessarily bad things, but just things to be aware of. And so you'll see that slide at the end of every section. So self-funding, okay. So you are always the first money in, right? So anybody will tell you self-financing demonstrates your commitment. The use of your personal funds should be carefully planned. So this is not for the faint of heart. You've got to be very careful. And a sustainable business shouldn't require ongoing self-funding. So once you build that business, you shouldn't have to continue to fund it. Okay, so at some point you'll generate cash flow and the business will be able to either fund itself or use outside funding. What you'll hear a term, and it's called bootstrapping. And this is a good term. It's something every entrepreneur should add to their vocabulary, because the people who are down the line from an investment perspective love entrepreneurs who know how to bootstrap. And bootstrap is simply the process of starting and growing a company with very limited resources and doing more with less. There's a saying, necessity is the mother of invention. You'd be surprised how much innovation can come out of a venture that's financially constrained. So if you can show a lot of progress and creativity through bootstrapping, it really serves you very well going forward. Oops, sorry. And then there's this concept called relative burden. How much money do I put in, and how much money is really appropriate, and how does that maybe viewed by an investor? So there's a couple different types, right? It's what is that? What do those dollars mean to you relative to your situation? So on the left, we've got somebody who maybe is giving up pizza and beer, and that may be pretty significant for them, given their constraints, or giving their income, or giving their situation. But on the other hand, you may have somebody, maybe a more well-heeled investor, giving up a trip to Italy or Europe with his wife for his or her spouse for as an investment. The pizza and beer actually relatively may hurt more to the first individual than the trip. So it's the sacrifice and what it means. I had a couple clients, I'll give you an example, that were, building a platform, and they put 50 grand in, and 50 grand is a lot, not a ton, but it's a lot. But these guys were working, they were doing their venture during the day, and they were working the Amazon shift from 4 to 8 in the morning, 4 to 9 in the morning. And them putting 50 grand, it means a lot. So it shows an investor there's some commitment there. What are the sources? So there's a couple different, right? Of course, if you have savings, that's important. A lot of entrepreneurs have a daytime job. They can use that to fund their venture. A lot of them have partners or spouses that bring income into the family while they're working on their venture. Right now, houses, real estate. If you own real estate, and you've done pretty well here in the last 18 months, 2 years, there's a lot of equity in there, places to tap, and there's 401ks. So it just gives you an idea. There's a lot of different avenues from a personal perspective that entrepreneurs can use. So let's talk about the pros and the cons of self-funding, right? If you fund it yourself, you have total control. You haven't given up any control to anybody. There's no investors. Of course, it's non-dilutive, right? You don't give up any control. You don't give up any ownership. Forces creative thinking, right? Again, you're probably constrained, and you're pretty careful with your own money. You establish some credibility. Saves time. If you can take money out of your own pocket and start your business, or when you do, you don't have to wait on anybody else, because these other avenues do take time, and there's work with it. So what's the downside? Well, I don't have to say personal financial risk, right? Stress and anxiety. You've got family assets that you may be tapping into. You got your kids' college funds, you've got savings funds, etc. And you can only really go so far to a certain extent with self-funding. It will at some point limit your growth, but that's okay, right? We kind of realize that. So I think I'd stated the obvious here, and we'll talk more about some of these other ones. So let's talk about startup debt. Okay, I'm going to just do a real just quick overview, because a lot of folks come to us for loans, and we do a lot of assistance with loans. But early stage companies oftentimes are not what we call bankable, right? It's challenging to get a bank loan for companies that don't have a financial track record. There are some typical loans that are out here. You'll see a 7A loan, which is an SBA loan, which absorbs some of the risk. There are 504 loans through the SBA, not through the SBA, that are SBA loans. They're all through commercial lenders. They're used for buildings and facilities and stuff like that. You'll see advertised startup loans, and you got to just be careful with what the definition of a startup is from a banker's perspective, right? They are still looking for some financial track record. Now, lenders, and I got a little picture here, lenders are risk averse. They are very risk averse, right? Startups are very risky. So that's kind of why they don't like to play. They have, it's unusual. A lot of these SBA loans, all of the SBA loans are let through commercial lenders. So it's really up to the commercial lender, a bank, ultimate decision as to whether they take on the risk of that loan, even though part of that risk is being absorbed by the SBA. And you have to look at the current environment. Today, in the current environment, given what's gone on with the pandemic and a lot of the EIDL loans and PPP loans that are out there, there's the lenders are really it's a really tough situation for early stage companies with regard to debt. We'll talk more about this, but I'm just going to show you, it's a little bit of a risk return comparison between maybe a bank loan and an angel investor. So I want to start out with $100,000 on a bank loan. Now, if you've got really good credit, maybe you got 6% interest, and maybe you take it over 5 years. So at the end of the 5 years, you're going to return the principal of $100,000. However, the profit or the interest to that bank is about $16,000. Here it turns out to be 15,997. Okay, so this particular banker is getting essentially $16,000 profit, or at least gross revenue off of your loan. Look at an angel investor. An angel investor may invest in an early stage company with $100,000, may expect a 10x investment, and that's not unusual. It's a 10x return on the investment. And I want it back in 5 years as an angel investor. So at the end of 5 years, I'm going to get my $100,000 back, but I'm looking for $1 million. Okay, so what's the difference here? We're both starting with $100,000. We have two different types of funders, lenders. It's risk. It really comes down to risk. The bank does not want to take a lot of risk, and they look for things that are not very risky. And we'll talk a little bit about that in the next slide. Angel investors are looking for risk, but need to be rewarded for that risk and are looking for significant upside. So who assesses the risk? They do, not us, right? We present what we can to them to let them know, about our venture, or either our financials, what's been invested, if there's intellectual property, the business plan, the whole works. They assess the risk. And so most early stage companies, they fall to the right, not necessarily to the left. So let's just talk about lending for a second. When we talk about the decision factors for a loan, if you come to a bank, they're going to look at your experience. They're going to, the SBA loans require a certain amount of down payment, 10, 20, 30%, depending on the situation. How mature is your product? What's your personal credit? Do you have collateral? Bankers love collateral, right? They'll try to attach to any kind of collateral that you can. They'll ask also for a personal guarantee on the loan. How good is your business plan? And then really finally, it's what does their portfolio look like and what industries are they investing in today? Not every lending portfolio is the same. So they may have an appetite for different type of industry sectors depending on what their existing portfolio looks like. So there's no yes or no answer, but there's a lot that goes into the assessment as to whether the bank is going to give you a loan or not. Okay, let's talk about startup debt. What's good, what's bad, right? What's good? You get your money to start your business. It accelerates your growth. You have control. You didn't give up any ownership. This is really critical for debt because this is really the big benefit for debt. You're not giving up any control. You're not giving away any equity. It's non-dilutive. Again, no owners, and you do build business credit, right? If you're able to secure a loan and pay that loan back, and that helps you going down the road if you need additional access to capital, to debt. What's the downside? It's challenging to secure, right? We talked about especially for early stage companies, there is personal financial risk because a lot of times they're going to ask you for a personal guarantee, especially if you're early. They'll try to attach to any collateral they can, including family assets, including your house, and it can constrain your cash flow. So that's all I'm going to say about debt. And a lot of folks come to us wanting a loan, and they realize very quickly, or we realize they're not very bankable at this point, and so you have to kind of maybe assess other alternatives. So let's talk about grants. And grants are also common way to acquire some capital early on. They exist at the federal, state, and local levels. So there's lots of different grants. However, the one caveat I will say is many grants, not all, but many are often targeted at nonprofits. So if you've got a business that's for the greater good and you want to build your business based on grants, you really should consider a nonprofit status. Grants are not easy to get in a sense, depending on the grant. I mean, it takes time, it takes effort, it takes some skill in grant writing to be able to get these grants. So there's that time and effort and skill. The conversation I have a lot with clients is, where's the government grant that's going to help me start my business? And the fact of the matter is, there's not there's not government free money to start a business. We can talk about SBIRs a little bit. We'll get down the road a little bit, but that's kind of a special situation. And the SBA doesn't provide grants, the government or the SBA. The SBA underwrites loans, helps absorb some of the risk of commercial loans. The CARES Act, many of you went through the CARES Act. If you're an existing business, you probably were able to get some assistance in PPP or EIDL. However, if you were a startup business and you didn't have financials, you were locked out of the CARES Act, right? There was not much there for you. And that's kind of come and gone. And really at the end of the day, even if you're good at getting grants, this is not the vehicle to fund your business totally, right? It's inadequate. So you can't really build your business on grants per se, although they are a nice addition if you can pick them up. My mouse is a little crazy here. So grants typically pre-award phase, funding opportunities and application review. Then there's an award decision by the granting agency, and then the post-award is the implementation. But then there's also this, a lot of times with these grants come onerous reporting guidelines or requirements and closeout. So there's 3 different stages. Here's grants.gov is the one-stop shop for government grants, federal government grants, and that's something that's available for anybody to search. I do have a couple folks that are grant consultants, so you can pay them to do your grant work for you. I'm not sure how cost effective that is, honestly. Again, just because of how much time and effort it takes, but it's something to consider. So the grants, good and the bad. Okay, so you get your cash, it's non-dilutive, right? We keep going back to this non-dilutive. We don't want to give up any ownership unless we have to. Provide some visibility in the community, right? So a lot of these grants are coming through economic development organizations or some other kind of organization that wants to provide an opportunity, and they want to publicize that opportunity. You can typically, you have some discretionary use over the grants of how you use it, and you can emergency funding was possible depending on the situation. We just went through the CARES Act. But the downside of grants, it's time to invest. It's a lot of work to find these grants. Got to have grant writing expertise. The reporting requirements at the end, sometimes as much work as the grant. Again, not sustainable. Small increments, so the dollar amounts are small typically, and they're very competitive. That's one thing I didn't mention. When you're going for a grant, you're competing against others who's got the best who's got the best proposal, who writes the best application, who's got the best story. So that's it on the free money. Now I'm going to talk about friends and family. So this is typically after you fund it yourself. Friends and family are a way for you to take that next step. And as an investor, if you put your money in and friends and family put their money in, now I'm feeling a little bit better about putting my money in. But so why do friends and family invest? Well, again, they know and love you. Your aunts, your uncles, people who are willing to put their trust in you to deliver on your business plan, no matter how vague or concrete it might be. You don't really have to have investor grade materials. Having some thought through it, having a story is really good, depending on your family. Maybe how much, how much they love you or how much they, trust you. And you might take small amounts of money from several family members to raise a significant overall sum. And it can, in a way, it's a form of crowdfunding. If you think about it, and matter of fact, there's some of these crowdfunding platforms you can use for a friends and family round. So on the friends and family, you'll also hear a term called friends, family, and fools. And so friends, why friends invest? Because they believe in you, not because they believe in the venture. Why do family typically invest? Because they believe in you, not necessarily in the venture, although the venture could be good. Now, the fools, who are the fools? Well, they don't recognize the risk of the venture. They may be not friends or family, but they may be willing to throw money at something that they really truly don't understand. And so you just got to be careful there. That's where the term fools typically comes from. Careful consideration. From friends and family, you don't want to, you don't want to take all your Nana's money to kick off your company if you really don't think it's going to go forward. However, though, I will tell you, as an investor, if you take Nana's money, and I know you took Nana's money, I know that you're going to be very diligent in your pursuit of your venture, right? Because you're going to answer to your family, and that's important. You need to be careful. Take into consider your financial position and their financial positions, and what's going to happen, if you fail, how are you going to harm your investor or your friends or your family? So it's just a plug for just, it's important, friends and family, but just, be responsible with it. So here's, when we talk about friends and family, there's some different vehicles you can use for friends and family around. So it could be a loan, right? It could be a simple note with the expectation of repayment with interest. If the business does well, I don't know if you have to personally guarantee it on your friends and family. The downside is, right, as an investor, as a friends and family, you don't get to participate in the upside or the increase in valuation, right? So if it's a loan, you're getting your interest, you get your money back, but if this thing really takes off, you don't really get the upside. There's something called a convertible note, which is really a way for a loan to convert to equity at an initial valuation event. So it acts as debt until the valuation event occurs, until an equity investor comes in, and then the investor has the same rights as the debtor, or the debtor gets the same rights as the investor. So your friends and family would get the same rights as typically the investor when the convertible note converts. These are easy to do, fairly simple ways to do it. There's something also called a SAFE, which is a cash investment that converts to equity at initial valuation event. So the difference between a SAFE and a convertible note is you don't really start out with a loan on the SAFE. There's no loan component. It's just a cash investment that converts. And what you're doing here, these convertible notes in the SAFE, is you're really pushing the valuation event down the road. So you're waiting till a professional investor comes in, you make some progress to actually value your company. Really hard to value up front, early, really hard to set a valuation with your friends and family. And so that's why they use these vehicles, and they're very popular. And then, or you could do a priced round, an equity round, where an investor buys shares after agreed to valuation and price. The valuation gets set early, which can be a downside for you, depending on how things progress. So what's the pros and the cons of a friends and family round? Let's just recap, right? It's convenient, it's accessible, it's pretty quick. It can be pretty quick. You can secure funds from folks pretty quickly if they're ready and have accessibility. Doesn't really cost you very much to do this. And again, establishes credibility and commitment, just like self-funding did, as you get down the road and you talk to other investors. Now, right, if we ever been in business with our family, in business, or now you're taking money, now you have relationship and business entanglement. Do you really want that? It provides higher risk for the family unit, especially if you start borrowing from the family or taking funds from the immediate family or the extended family. The investors may not be very savvy, and I can promise you that probably not, right? And that's okay, but potentially you may have a built-in panel of critics, right? Depending on who you take your money from. So now you've got relationship entanglement, you got risk, you've got this panel of critics. It's up to you to manage, right? I'm not saying you don't do it. I'm saying you probably should try it, but these are things to really watch out for. Okay, so then we're going to talk about crowdfunding. And this is, this has been the last 5 or 6 years, you've kind of seen an emergence. There's 2 different types of crowdfunding. Okay, so there's the non-equity, the donation rewards, like Kickstarter, Indiegogo, even GoFundMe is kind of a crowdfunding site, right? and you could put your venture on Kickstarter and attempt to raise some money, but you're not giving up any equity. You're going to give them something. Usually it's the product or some service or something along the lines. But then there are equity based crowdfunding platforms that have really come, we've seen them emerge here in the last 3 or 4 years. Fundable, and these are just a couple. Crowdfunder, WeFunder. In this situation with equity, you are actually giving away a value, a portion of your company. You couldn't use convertible notes through these sometimes, many times, but it is targeted towards somebody who's going to own a part of your company at some point. And we're going to talk. What are we going to talk about here? We're going to talk about. Oh, okay. So let's just example of Kickstarter. It's dedicated to creative projects, not necessarily charity or personal use. They need to approve all the projects. You're obligated to provide rewards to your backers, and the rewards must be your own creation. The project must meet its fundraising goals within a set period before you receive any funding. So you have a goal, and if you don't receive that, if you don't hit the goal, you don't get your money. Kickstarter will take about 5% of your raise, and the backers are only charged if the project is successfully funded. So if you get through your funding goal, and like with anything else, if you have expertise, you're going to be more successful. So there are fee-based experts available for help with campaign strategy, storytelling, backer engagement, and management. And so I've seen folks engage third-party service providers to help them with Kickstarter because they tell a good story. And this is really what it comes down to: creating a successful crowdfunding campaign. It has a lot to do with how you tell your story and how the marketing power behind it. I don't know if anybody's ever been on the crowdfunding sites, but a good crowdfunding campaign really jumps out, grabs the potential investor or investors' attention. Investors and donors love a good story. And you just need to tell that story through a project page, as a video, your social media, your blog, email, every other avenue possible as you create the crowdfunding campaign. But let's talk a little bit more about WeFunder. And this is a reg. So the up until I think it was the Jobs Act, you couldn't crowdfund for equity, right? And then they came out with what they call Reg CF. And so these are the SEC regulations. It's called Reg CF. And you'll hear that term associated with crowdfunding, equity-based crowdfunding. So, but what this does, it provides a way for non-accredited investors with limited capital to invest in early stage startups. Beforehand, you had to be an accredited investor. We'll talk about who they are, but they're typically high net worth individuals. Non-accredited investors were really kind of locked out. So this gives an opportunity for non-accredited investors. Typically, a single purpose LLC is formed for the investment, and there's a single entry on the cap table. This is important, and this is a good feature of these crowdfunding platforms, because assuming you're going to get some professional or semi-professional investment down the road, the last thing a VC or an angel group or an angel wants to see is a cap table with 20, 30 people on it, all in at $1,000 a piece, right? So that becomes an issue with regard to the next investment and how encumbered that business is. So what happens is they form a single purpose LLC, right? So they all get together. So there's one entry on your cap table. It's all those folks are owners of the LLC. That LLC is on your cap table. And that's important. There are lead investors associated. They've vetted startups and made investment based on the startup's term. There's a term for them. They're called lead investors, and there's kind of a compensation. They get 10% of an investment profit on the initial public offering or the acquisition. So they have some down the line incentive to participate as a lead investor. let's say for the CF investments, WeFunder charges up to 2% of their investment They also charge company raising up to 6% of total funding volume, 4% cash, 2% some other flavor, either an equity or a warrant to purchase equity. So WeFunder makes money on both sides, and that's how they fund. So I'm going to give you an example. So actually, this is an old slide, right? Oh, no, okay, no, I got you. So this is one of my clients, and the client was able to provide me with some information and allowed me to use this slide during this presentation. If you go to WeFunder, you look at a company called Carlocity. A little plug for these guys. They're anonymous car buying platform, which has turned out to be really interesting. And they've raised, it said 160 here. They've raised, I think it was 177 at the end. But what they did was, it was interesting. They used the platform to aggregate their investment from friends and family. So their friends and family were about 117,000 of this 177 or 160,000 at this point. After the initial raise went to friends and family, help get the you have to get to the initial raise of $50,000 for them to become live, and for WeFunder to put this out into their public profile. So it starts out as a private investment. You pull your friends and family together, or you market for your own investments. You come through the platform, you hit $50,000. Then WeFunder says, okay, you guys are legit. We're gonna start to push this out to our other investors on our platform, and you get some additional visibility. In these guys' case, they raised 2/3 of their raise from friends and family, 1/3 from outside investors via the platform. I don't know if that's fairly typical or not. And the important thing was, and this is really important because the founder, he curated his own marketing copy and materials. And if you have a chance, go look these guys up. He's really good at writing copy and putting together his marketing campaign and his story. And that really helped. So he didn't have to use anybody from the outside, but it was really important. And I think it was a key differentiator. In addition to he's got a good venture. So there's an example of a successful WeFunder funding campaign. So let's talk about Fundable. This is another one, right? So we had a couple of equity ones that we talked about. Fundables is one. Let's see. So only accredited investors can contribute to this equity crowdfunding campaign. The minimum investment's 1,000. There's no maximum. 1,000's for a fairly small investment for an accredited investor. Instead of charging a percentage of the money you raise as a fee, Fundable charges a flat monthly fee of like $179. And most other crowdfunders take a chunk, usually 5%. And they're kind of tiered. There's different packages. Premium package available for a one-time payment of $24.99. It's an all or nothing model of crowdfunding. If you don't reach your funding goal during your funding period, you get nothing. So you have to make your goal to get your funding. Otherwise, the money goes back. And this is interesting. You don't pay the percentage, right? But you're paying a flat fee, and you just got to, have some kind of degree of confidence that Fundable is going to go through with their end of the commitment, and there are qualified investors on their platform who will invest. So that's a lot to be said. They are credible. People use them. Not everybody has used them successfully, I will tell you. People have paid and not had the traction that they expected. Not necessarily Fundable's fault. A lot of ventures maybe aren't ready, or don't have the story, or don't have a lot of other things. So that's what it could be also. So we get to the end of crowdfunding, and we want to talk about the pros and the cons, right? So the pros, accessibility to funds, right? We're getting cash, reducing our financial risk. You build momentum, you start to get investors. You test the marketability. You see folks are liking what you're doing. Opens access to new networks. So everybody you meet, everybody that invests, everybody that sees what you've got knows other people, and there's a network effect. If you're good, you'd be surprised, as you start to get the word out, how other folks will find you. And this goes for other avenues too, not just crowdfunding. Takes time. Takes time. I mean, I think Carlosity's crowdfunding campaign went for I'm going to say 8 months, maybe. It's a lot of that takes some time and takes some money, right? You're going to pay some money either on a flat fee, or you're going to pay it on the back on the front end or the back end. There are fees. You could have a failed campaign. You're putting your idea out there, and so there's idea theft potentially. And this is always a risk when you're out in the entrepreneurial community. Not everybody has IP protection. Not everybody can get IP protection, and most investors won't sign NDAs. And you may get a false negative, right? So you may go through crowdfunding and really not do very well, but it may be just because you didn't maybe exercise the platform correctly, and maybe you really should continue. So you don't really want to be just too discouraged if you don't necessarily make it through the crowdfunding campaign. Okay, so let's see. I'm about halfway on my slides, maybe halfway done. How am I doing on time? Okay, well, all right. We'll see how far we get here. Okay, so incubators and accelerators. Okay, here's another opportunity for funding, and you'll see this. Incubators, there's a difference, right? An incubator refines business ideas, building company from the ground up. It's an environment of collaboration and support when needed. So it's really an incubator. You're new. You typically pay for an incubator. Typically, you apply, and then you'll maybe be some fee structure for an incubator for those services. Now, an accelerator is a little different, right? It's designed for selected startups with promising, call them MVPs, minimal viable products or ventures, promising founders, and a way to rapidly scale growth, right? So now as an accelerator, I see something that's very promising. I want to accelerate it. I want to give it mentorship. I want to give it capital. I want to provide connections to investors and business partners. So typically, where the overlap here is incubators and accelerators. If you look at a Venn diagram, a lot of them do some of the same things: training, mentoring, business support, selective. They are selective, but mostly you'll see seed funding is really kind of in the realm of an accelerator, right? Because they'll provide not only investor contacts, they may provide some capital up front. We'll talk more about this in a second here. So accelerators provide capital in exchange for a percentage of your company's equity. So it's typically 7 to 10% of the company. So now, you're coming in, they're going to give you some money, and you're going to start to dilute. But you think it's worth it because there's expertise there, there's connections, there's folks who have done it before that can maybe really help you get through it. Some accelerators ask participants to pay for the program. That's not uncommon, and still want to take a percentage of your company. Typically, it's either common stock or preferred stock for an accelerator. So what's good about accelerators? What's not so good? So good, you're going to get cash, you'll get mentoring, you'll get some training. There'll be a cohort. I didn't mention that. Usually they bring them together as a cohort. So you'll be in with a group of different ventures, 6, 10 ventures together. And there's really, there's some fertilization there, cross-fertilization between the ventures, because you can learn a lot from others and you can keep those connections. So that's really important from an accelerator perspective. But on the other hand, there are programmatics. It's like, if you're an accelerator, there's going to be expectations of you. There's going to be program content for you. There's going to be time committed to the program. So, you're taking, you may get some money, but you're going to be beholden to their program for a certain period of time. Could be a couple months, it could be 6 months, it could be a year, depending. And you got to think about that, because depending on where you are with your venture, you may not want to do this, right? You may not need to do this. Dilution, again, you're giving up some equity at this point. There's the fine print you have to think about. what are the warrants, right of first refusal, NDAs. They could, with their ownership, they could hamstring you a little bit with regard to other terms in your ability to raise money in the next round, and having some say over how you do that. May be good, may be bad, but typically you have to really be careful. Okay, so now we're going to switch over to competitions. So this is also an area where you can get some funding, and some significant funding. I'm going to talk to you about Venture Madness, which just occurred here this month. The AIC Challenge, a little bit about Founders Live, ASU Venture Devils, and our own MCC, Maricopa Community College Big Pitch competition. So this is not all of them. This is some of them here in town, some of the more well-known ones. And let's talk about those. Right, so competitions. So here we're talking about Venture Madness. And so Venture Madness is put on by Invest Southwest in partnership with the ACA. And it's one of our premier pitch competitions. There's nominal cash. I don't even know what the cash prize was this year, but there's a lot of exposure to investors. Typically, it's a statewide event, attract outside, out-of-state investment people that will come. There is an application process and a screening process to get you through to present. I think they had, I don't know, 4 or 5 categories of 4 or 5. So maybe there was 20 that got to present. There are different categories in Venture Madness. So there's some consumer, medical, depending on how they kind of put it together for that particular year. And for we call finalists are the folks that go through the competition and are actually able to present. There's mentoring. So it's really good mentoring. You get some really good mentors will help you with your pitch, will help you with your business plan. Very, very valuable. The application window is typically April through June. And I think that'll be probably for the next round. I think we'll go in October. There's free pitch training. August, the finalists are announced. Again, the conference in October, yes, typically. So they just did their, you know what, I had done this slide and I got to apologize. They had one in October of this year, and they went to a spring, I think, schedule, which was the March one. I think they're going back to a spring schedule. It's typically once a year, but I'll clarify that for you guys. So I apologize, but keep your eye out for Venture Madness. Very important. There's the AIC, Arizona Innovation Challenge, put together by the Arizona Commerce Authority. And since 2011, the ACA's selected 110 winners and from over 2,000 participants, applicants. So in this particular competition, there's $150,000 combination of discretionary cash and services. You've got to put an application in. Up to 10 companies are selected, and you get to go through their venture accelerator as part of this. Their application windows, July, August. There are some virtual workshops that are held after there's some down selection done. There's 3 judging rounds to select 25 semifinalists. Again, October, selected 15 finalists to pitch. So there's a whole funnel to down select, and you have 15 to pitch. I think 10 won this year out of the 15. And there's an opportunity to provide feedback also. So this is really a really good statewide competition. There's some dollars, there's some accelerator opportunity, there's exposure. So yeah, all of my clients who are and this is innovation, in the innovation space, I always encourage them to go through and apply for the Arizona Innovation Challenge. Founders Live, and this is something that you'll see, it was here, and I think they're coming back. They're a kind of a nationwide organization that does local competitions. So you give these 99-second pitch competitions in select cities. They've done them in Phoenix pre-pandemic. I hear they're relaunching in Phoenix, but there's some nominal cash and services that they're giving out, like $5,000 here or there. So they're kind of neat. Even if you're not pitching, to just attend. It's a good crowd of folks that are there, good for networking, and you do get to see some good pitches. And they're fast. They're 99 seconds, so they're rapid fire them. They'll do 5 or 6 or 8 or whatever, and then I think the audience votes. The last time I was here, the audience voted on their phone through an app. So keep an eye out. So here's ASU Venture Devils. I was fortunate enough to judge one of the sessions this year. So Venture Devils supports all ASU students, faculty, staff, and community-based entrepreneurs with an affiliation ASU. So you think about ASU and how big they are and how much, their footprint. There's a lot of folks that are eligible for Venture Devils. I think the affiliation is alumni, lots of alumni. So applications are accepted and processed 5 times per year. It has access to provides access to venture mentors and space. There was total of about 500,000 in funding and support annually. So that's about how much. And there are several categories to deliver investor style pitches. So you'll see this gal here, I'm looking, has a check there for $1,000. I think in the session I was at, we had maybe $25,000 to divvy up between 3 winners. I think there were maybe 12 contestants in our session. And I think we gave like 15,000 to the first one, 10,000 to the second one, and I don't know, 5,000 to the third one. Maybe that's not 25,000, but anyway, yeah. So that's kind of how it went. And that's nominally how much you can get from Venture Devils. It's a good competition. A lot of students, but a lot of non-students, a lot of faculty and staff. So very, very informative and having funds to present. So next one, big pitch. So this is a competition through the Maricopa Community College District. As a matter of fact, it's coming up, and it says Wednesday, April 13th, but I think we're doing it virtually over the first week of April. So, but there's students who attend the Maricopa Community College District, any of the colleges, and there are 10 student entrepreneurs will pitch a business or idea to a panel of local leaders. And this year, thanks to Wells Fargo, there's 3 large cash prizes with the 3 winners, not just one. Typically, there was one cash prize. It was a cash and services prize. Now there's 3. I'm not sure what the amounts are, but again, incremental. These are thousands of dollars. $2,000, $3,000, $4,000, $5,000, maybe a little bit more, 10,000 at the most. Sounds like a lot, and it is a lot, but in the scope of funding your business, it's not necessarily going to satisfy most total funding requirements. So let's talk about competitions. What's good, what's bad. So you get your cash, you get services, combination typically of thereof. Accessibility, they're very accessible. You get some programs that are part of them. You get a lot of exposure. They're good. Exposure is really key. And any of your entrepreneurs that are out there, any of this anything that I'm doing that can get you exposure helps you get to where you need to be with regard to your venture, whether it comes to investing or clients or mentoring or anything. So participating in a pitch competition but not winning is is not, can be fine. You may get a lot out of it other than the cash. That's what I'm trying to say. So on the other side, time, it takes time. So nominal awards. All right, so the awards aren't huge. Their services, typically they're tied to it. So sometimes they'll give you, if it's $10,000, maybe $5,000 in cash, $5,000 in services. The services are provided by that particular entity or an affiliate. Could be legal services, could be anything, right? Could be marketing services. Sometimes there's non-discretionary cash. So sometimes they will allow you to spend your cash in certain ways. So you have to be careful and just know what you're getting into. There are reimbursement models sometimes. So basically they may not give you the cash. They may reimburse you for the cash after you've already spent the cash on the particular service. So that's important because a lot of startups don't have a lot of cash to start with, right? So that puts a real strain on cash flow. There are programs. I have it on the negative side. That could be positive or negative depending on the program. And then there are reporting requirements. So a lot of times, like for AIC, I know that if you're required to report to them over the life of your company or for a certain amount of time for your economic impact in the state here. So it's just overhead for you to be cognizant of. Okay, so let's switch to SBIRs. So again, lots of different things here. I know I'm throwing this at you pretty fast. We'll have a copy. This will be recorded, made available to you. A copy of the slides will be sent out. So I know it's a lot. So let's talk about SBIRs, STTRs. So an SBIR, STTR program is a competitive three-phase water system. It's part of 1982 Small Business Development Act. Federal agencies with over $100 million in external extramural R&D are required to allocate a percentage of their budgets exclusively for small businesses. So we're talking about big budgets, small percentage of big budgets, which is a lot of funds. We'll talk more about it. So these are the participating agencies. There's 11 for SBIRs. There's 5 for STTRs. I probably won't get into the difference between the two. It just has to do with the amount of subcontracting, but there's different pools for the SBIR versus the STTR funding pools. But just be aware that there's these 11. National Science Foundation is the broadest. Department of Defense, usually, and the NIH, which is Department of Health and Human Services, and NIH, they usually want an answer to a problem or a product that they want developed. They're very, very important also. So you have kind of one end of the spectrum and the other. The benefits of an SBIR is it's non-dilutive capital. So the funding agency cannot take an equity position. The government can't share data with anyone outside the federal government for a uniform 20-year period that begins on the date of award. And there's direct on follow-on phase 3 awards. So with some of those 11 agencies, I'm going to use the DoD. They may, if you get through a phase 1 and a phase 2, which I'll talk to you more about, they will give you a phase 3 award, which is actually a procurement contract for that particular product that you've developed really on their nickel. So not all of them do that. Some of them do. DoD happens to be the big one that does that. Now, why do investors like SBIRs, right? And this is kind of how I learned about them, because I was an investor, and I learned about this money that was being provided to innovative companies. So it's early capital injection, right? So we're still pretty early here. This is stuff that's in the proof of concept stage, pre-seed stage, seed stage. It's non-dilutive, so I like it, right? So here's money that's being put in to a company to de-risk it, and no one is necessarily going to own it. So I like that, right? There's a level of validation with SBIRs, right? So there's this scientific vetting, which goes on. It's because it's a competition when you put your proposal in. they'll evaluate your science with experts in that field. And then there's also a level of validating with commercialization, because these grants are not necessarily basic research grants for discovery. These are grants to take a technology out of discovery and begin to commercialize it. So that's kind of the way these proposals are written. Again, it de-risks the investment, which is great. Again, early capital in, technology risks starting to go down because now I'm starting to prove it. Maybe I've done a prototype. But on the other hand, simply receiving an SBIR grant does not mean the company is a good investment from an investor's perspective. So, you have this vetting that's done scientifically. You've got the commercialization plans that are done. NSF or these other agencies are really skilled in what they do, but they're not necessarily venture firms. So just because they've seeded you with a couple $100,000 or even up to $1 million doesn't not necessarily mean that it's a great investment for an investor. So what I tell my clients is this is good. This is good money, and if it's right for you, you should pursue it. But it does not mean just because you won yourself a phase 1 or even a phase 2 that you're going to people are going to start just throwing money at your venture. That's not necessarily the case. You still have to have a really good technology and a really good commercialization strategy, in addition to a good team. So I've thrown this out, these phases, but I didn't tell you what they were. So let me backtrack a little bit. So the phases in the SBIR program, there's the phase 1, which is a feasibility and proof of concept, which is typically your first entree in. The budget guide is 150 to 250. That's, I think, the latest NSF solicitation was up to 275 for a phase 1. It's a 6-month period for the SBIR, 1 for the STTR. And this is discovery. This is a proof of concept. Okay, so there's a commercialization section, but there's also a technology, a plan that gets you to a proof of concept, right? So you move into a phase 2, and now you're talking about development. So now you're taking this research, taking this proof of concept, because to get to a phase 2, you have to have been awarded a phase 1 for the most part. There are some direct to phase 2s, not really for this conversation, but the budget guide's about $1 million, and it's over about 2 years. Okay, so this is good, right? If you get to a phase 2, now you got your prototype. You don't have a product per se, and you're not ready to go to market per se, but you have you're taking a technology and you've got a prototype, a working prototype, and that's encouraging. Commercialization's your phase 3. So this has 2 different meetings, right? So phase 3 for a non-procuring agency means commercialization, means you're going out and you're going out raising the capital to continue to build on what you've already developed through the phase 1 and phase 2. To commercialize your product without the help of anybody, not the help of the government, right? No, there's no procurement contract. That's commercialization for the non-procuring agencies. I'm going to use NSF as the example. The DoD, their term of phase 3 for a procuring agency, and I'll use DoD as an example, is a procurement. So it's actually a phase 3 commercial procurement contract for that particular device. It may require you to go out and get some additional funding to be able to procure that, to be able to fulfill that contract. But there is an actual contract, a government contract, that is at the end of that. So let's recap again. And it's some of you maybe have been on some of my SBIR webinars. We go into a little bit more detail in SBIRs. I think I've got one coming up here in the next couple of months, so keep an eye out for that. SBIR is a good chunk of change pretty early. It's really for, when I was on a call with the NSF yesterday, they were doing a presentation, and they're like, bring me your most risky endeavors. We want to see the cutting edge science. So it's really for folks who are on cutting edge of innovation and risk. That kind of goes hand in hand. Again, non-dilutive, you got IP rights, data rights, and there are potential government contracts depending on who you're working with, if it's a procuring agency or not. All right, the downside, it's complex, right? This is not for the somebody who's never written a proposal before. It's very competitive. So I will say first maybe 20%, 10 to 20% maybe get funded. And these are good proposals too. These are proposals that have been through vetting. It's a long timeline, and most folks don't realize this. Let's say for NSF, I'm going to give you their example. 1 month, you do a project pitch. If you get invited to do for a phase one, you do your phase one. We recommend 3 months to do that. You submit your phase one, and it's 6 months. You'll hear back in 6 months. You get your funding in 7th month. So you're talking a year. Now, a year, if this is your only way to fund your venture, okay, a year doesn't, is maybe not that long, but if you're on startup time, year is a long time, right? And then if you go to a phase two, right, now you're talking another year or two. So, you're talking years to get this funding. And again, people utilize it. It's very good, but you have to understand the timing. It's not for existing products. Again, I emphasize innovation risk for the NSF, but also for the NIH, or let's say the DoD will put out solicitations for things, complex problems that need to be solved, not necessarily funding the development of your existing products. And there's this thing, too much of a good thing, right? So you can get really good at writing SBIRs, STTRs. If you're a company that has got multiple SBIRs, STTRs, phase ones, phase twos, but you haven't really commercialized much of anything, as an investor, you kind of start to think, okay, is this just a research organization that knows how to get SBIR, STTR grants? So you got to be careful. So use it as a stepping stone, as leverage to move your venture forward. But again, you have to be careful about doing too much of it. Okay, so how are we doing on time? 11:11. I got 15 minutes. So I think I can make it to the end, guys. And then what we'll do is we'll leave 15. We'll take an extra 15 minutes probably for a Q&A. Hopefully you've budgeted a little bit more time in your schedule and can hang with us. I see some Q&A up there already, so we'll address your questions. So let's talk about angel investors. Now we're pretty far down the road, right? If we're talking about angel investors, and that's important, right? So folks need to understand that before you really be taken seriously by an angel investor, you're pretty far down the road. Angel investors are high net worth individuals, provide early stage capital. SEC regulations called Reg D gives them an exemption for these type of securities. There's a definition of an accredited. You have to be an accredited investor to be an angel investor for Reg D. Net worth of $1 million. There's some income, $200,000, $300,000 for married couple, and there's an amendment that talks about qualifying based on certain professional certification designations or credentials, which is different than necessarily having income or wealth tests. So that's been put into play. So when you talk about angels, we talk about groups versus individuals. So let's talk about groups first, right? Groups are made up of individuals, right? So there are groups who have formed, and they're not profit enterprises. They are affiliates. There's I'm not sure what their actual legal status is, but you typically pay a membership fee, and the group will organize itself, attract different potential ventures for investment, screen those ventures, and then as a group they're evaluated, and then they are invested. The individuals invest. So that's important. So the group never really invests. Even though there are groups, there are individuals in the group that invest. However, they do invest in the same way as the crowdfunding, when we talked about having a single entity on the cap table. Typically, they'll form a single purpose LLC for the purpose of the investment. And anybody who wants to invest will invest through that through that LLC. So what I'm trying to get to is when you go to an angel group and you get a yes that we want to invest, it's not necessarily a digital decision on how much and who. It's folks in that group that raise their hands that want to invest, and those 5 or 8 or 10 go and form this LLC, do their due diligence, and then decide, and then put an offer together and invest together in this single purpose LLC as facilitated through the group. So groups are hard to get in front of. If any of you have tried, the screening process is pretty I wouldn't say onerous, but they get some fairly good applicants. So if you get through and you get exposure, typically what they do is they'll have meetings. I know the group I was a part of did them 4 or 5 times a year. We get to see anywhere from 2 to 4 ventures during our big meeting with the constituency. So what is that? 12 or so a year we got to see and invest in. And there may be in any particular cycle, there may be 40 or 50 that apply. But even getting through the process, if you're kicked out, it's not a huge deal. You can reapply. Sometimes it's luck of the draw, just who you're competing against that time. And they'll typically give you some feedback on why you didn't make it through. But if you make it through, it doesn't necessarily mean you're going to get invested in. But odds are you probably will, but you'll get some exposure. So now let's talk about individuals. So now there's individuals out there that are angel investors also that you might meet. They may be, a lot of them are part of different groups. There's 2 or 3 or 4 in town or in the state. I know individuals that are part of 2 or 3 of them, but they also invest on their own, right? The good thing about the real benefit for someone like me who had just was a new angel investor, I came out of the corporate ranks. This provided what I call deal flow introductions. I didn't have to go out and find, or they didn't have to find me, which is really kind of hard when you think about it, especially for quality. This was quality investments put in front of us on a regular basis. Individuals, you as a venture and that individual have to find each other. A lot of times they'll find you versus you finding them. But they also have the expertise and maybe confidence to go out on their own and do it themselves. Maybe they've done a lot of groups. Maybe they're not happy with the groups, but they just feel more confident. So I think from a venture set perspective, you have to, here in the group you're meeting with, you can be meeting, if you get in front of 80 people, that's 80 people, right? You may have to do 80 meetings with individuals and find those meetings. That's a lot of work. I would encourage you to do both, but the fact is to find these individuals to be able to pitch those individuals, you're talking 50 to 100 type of meetings to maybe get your investment, because not all of them again are suitable for you. So that's how that kind of works. What do angels, what's their appetite? Okay, so what do they want? They want, first and foremost, they want a good management team, coachable management team with some skill, some domain experience. They want a venture that's scalable, right? Capital efficient. What's the most scalable, capital efficient venture we know? Software, right? So they like software. Market size, it's got to be a big market. They're looking for early traction. Now you're, like I said, you're farther down the line, right? Have you, with whatever you've got, have you engaged any customers, any clients? Do you have any traction in the marketplace? That's important. Risk mitigation. How are you mitigating your risk? What are your risks? Can you identify your risks? Last thing you want to do is talk to an angel investor and tell him you've got no risk, because they understand risk. They know how to manage risk. They know how to invest in risk. They know how to assess risk. You can't make it too tough on them to, during due diligence, they'll uncover your risk, but you kind of want to be upfront about where your risks are. And they'll help you mitigate it actually. Financials, you need to have some financial forecast at least, or existing financials based on your current run rate, your current burn rate. And not most important, but last but not least is an exit plan. How am I going to get my money out? In 5 years, who are you going to sell this company to? What are they going to pay? What's the multiple? How am I going to get my money out? What is that return going to be to me? You have to have an exit plan if you're going to talk to an angel. Okay. So I think I talked about this. I'm going to skip this. It's not angel groups. It's not a consensus. There's no funds, right? There's these sidecar funds. We'll talk about those, but this is kind of the way even in the group, it's made of individual decisions. So if 2 people want to invest, 2 people will invest. 10 want to invest, 10. If 100 want, 100 will. Here's some of the local groups. ATI is here in town. Mostly technology-based companies. Go on their website. They'll tell you who they're looking at, what verticals they like. There's Canyon Angels. They're here in town. They're associated with GCU. Desert Angels down in Tucson. They do a lot of. They're a very active group. You've got Golden Seeds here in town, but they are typically geared towards women. I think their board and their investment group is mostly made up of women, and they look for women-based ventures. A couple other ones, Arizona Founders Fund, as Arizona Disruptors. Some of these funds were created by some folks here in town who've had exits. Which one? A lot of them. One of them is SaaS based. If you're software as a service, I think it's the Founders Fund. But anyway, so there are groups here. There are groups. So I should say there are groups outside of the state too. You can approach, but typically Angel is they're pretty much local because they like to know who you are, kind of who you're connected to, but you can approach out-of-state groups also. Okay, why angels? Lots of significant funding. Angels can take you up to maybe $750,000 in funding, $1 million, down to a couple $100,000. There's added knowledge and experience. These angels, they come with experience, right? They want to be able to help you with your venture. Increase the odds of success. There's some validation. If you get an angel, if you've got an angel group invested, you've got some validation with other angel groups. If you go out for more funding with venture capital, there's networking. Minimal paperwork. It's not a huge paperwork effort. And again, they're expanding outside the local area, especially with what's happened in the last 2 years with everybody moving to remote everything, distributed everything. Local groups from other locales are more interested or more accepting of outside ventures. Bad thing about them, well, not necessarily bad, but never the first money in, right? Difficult to engage. Dilution control. Typically, there's some dilution. They'll take a percentage. They may ask for a board seat. They may not. Not always. Angels don't always want control, honestly. Role clarity, depending on who your investors are. Higher expectations, right? There's these guys are screening you for at least 10 to 30x return in 5 years or so. And the process could be slow. It's not necessarily quick to get through. It's months to get through the funnel and get in front. And especially if you're not going through groups, if you're doing individuals, you got to kiss a lot of frogs a lot of times before you find the right investor. So let's move on to strategic investors. So a strategic investor is different than an angel investor, is different than other type of investors. They're more partners, and they're interested in the long-term growth of your business. The investment could include cash, which is kind of what you want, but more likely will be based on a synergistic relationship with the existing business. So it could be some kind of agreement on manpower. It could be co-marketing. It could be joint development. It could be distribution. It could be intellectual property. So these are investors that maybe have a business that's tangential to yours. And want to work with you, and maybe there's a cash infusion, maybe there's some other resources that are exchanged to tie you two together, but they're not necessarily looking for a a liquidation event or a return in a certain period of time, right? That's the difference. There's lots more of these than there are really angel investors, honestly. Strategic versus angel investors. So again, a strategic investor, two businesses form a mutually beneficial relationship. Angel investor is a semi-professional investor, right? Strategic investor wants long-term growth. Angel investor wants an exit. A strategic investor is happy with a share of the profits. Angel investor wants a liquidation event. Strategic investor may share a business domain with you because of their business. An angel investor may provide domain expertise. They may not, you won't likely have them as a business owner, but they will have domain expertise in areas that you may need, and they will help you with. How do you locate a strategic investor? Look at your span of influence. People you know, people who know you, your business, and your products. If you don't have a span of influence, increase your span of influence, right? It could be your suppliers, it could be your customers, it could be any related business, it could be a competitor, you never know. It could be a service provider to you. So it's all of these folks that you come in contact with at some point in your business relationships, they all become potential strategic investors. And you'll be surprised if you're good and they like what you're doing, they like you, they will find you a lot of times versus you reaching out to them. So strategic investor, recap, funding, that's what we want. Increased access, there's synergy with the companies, there's some shared assets. On the downside, it could be a control issue, it could be role clarity. You don't know, depending on what the strategic agreement looks like. Could be misalignment. Could be we thought we had alignment, we don't have alignment, and there's some loss of flexibility that could come along with that. So last one we're going to talk about here is, I believe, venture capital. So now we're pretty far down the road. So they employ venture capitals, VCs, and a lot of folks come to me like, I want to start with a VC. Well, can't really start with a VC for an investment. They invest other people's money, which they actually hold into a fund, right? So they have their investors. It's typically a capital fund, which is maybe from very large institutions or looking for a risky investment. They put small percentage of, like maybe pension funds. They're looking for high risk to diversify their portfolio, but just moves their small percentages. They kind of avoid early stage companies where technologies are uncertain, markets are uncertain. They like them a little bit later when there's competitive shakeouts or some consolidations that are inevitable and growth rates are a little bit slower. So they are, they're down the line. Their expectations of returns are less, but they are taking on less risk typically. Deal sizes. Okay, so check sizes. Angels go from 100 to 500K. I said 750 before. That could happen. VCs, on the low end, 2 million, really like 5 million, 200 million, and you got to need $5 million. You got to have a venture that can absorb that 5 million in a very productive way. They just don't have the bandwidth, or it's cost effective for them to do really small deals. Now they do. There's some of them that have some seed funds out there, but those seed funds a lot of times are reserved for maybe folks that they've dealt with previously who have really early ventures. So they're hard to really access. Just the number of companies funded per year, 75,000 a year by angels, 3,750 by VCs. So angels do a lot more transactions at a lower dollar volume. They almost equal what VCs do, lower volume at higher values. So just something to be aware of. Okay, so here's just some VCs have a high degree of specialization. They usually concentrate on 2 or 3 sectors. Here's Kleiner Perkins, they like hard tech, enterprise software, Excel partners, consumer, security, marketplace. They'll tell you. And the reason that, that they specialize is they really understand these industries. They've got internal expertise. They've also got affiliate expertise that they can bring in. So if you have a VC deal, a lot of times you may be taking on management as provided by your VC partner who has direct expertise in those in your particular sector. So again, their appetite, deal sizes, 5 million plus, they average $27 million per deal, growth stage, competitive advantage, nice clean cap table. Don't want those, you want everybody off, or, nice, neat LLCs. Angel endorsement is really good. Having a reasonable cash burn. A lot of these deals are sourced through personal networks and referrals. If you've raised money from venture capital before and successful, you made the money, you're likely to get additional venture capital funding. It's a lot easier for you. And again, I talked about the reserve seed funds. So venture capital, significant funding. They provide business expertise, whether you like it or not. Sometimes there's some contention there. They provide connections, they have resources, they can accelerate your growth. Dilution of ownership, definitely dilution, definitely ownership, definitely control. They can be difficult to access. You've got to have, have made significant progress to even really get serious consideration from VC. And the company may not be ready. Most companies aren't, honestly, that I work with here. And we got one more. Sorry. So I'm at 11:30. Corporate ventures. These are corporate ventures. These are corporations who have venture organizations that act as kind of like VC firms on the side. So I kind of did a lot of this stuff in my background. They develop capabilities on their own. They look for investments in external startup companies. They'll see technology. They'll buy a company if it's a good product to put in their product line. And so, many of them will hang their shingle out, right? So here's a bunch of, Qualcomm has Qualcomm Ventures, Intel. So Intel Capital, right? Intel, if you're going to go Intel Capital, you're going to have a technology that has something to do with semiconductors, right? You have Google Ventures, probably invest in anything. I don't know. But there's all these ventures that there's front doors as a process that you can attempt to access. A lot of companies don't hang a shingle, but they all have corporate venture functions internally, where they decide whether they're going to make or buy technology and or products for their portfolio. Unlike VCs, corporate venture, they try to achieve their goals both strategically and or financially, where VCs are typically financially driven. There's a strategic component to corporate ventures. Then there are financially driven corporate ventures that invest in new companies for leverage, invested through exits and sale of the company and stakes, certain such as IPOs, but more of it is strategically focused. Real quick, they provide cash, lots of domain expertise, credibility. They're patient. They have a long time investment horizon. Likely they don't want to control your whole company. They can do things like if you got a venture capital, a corporate venture in there, now you have to, any potential acquisitions or deals going forward have to align with their strategic interests, which may limit you. They may have a right of first refusal to acquire your company, right? So even they own 10%, and if you go to sell to somebody else, they may say, no, you can't. You have to come to us first. Intelligence gathering, they could also be a turn off to potential customers or businesses partners who view themselves as competitors in your as a strategic investor. So yeah, if you're aligning with Intel and they've got investment in with you, it's going to be hard. It may be hard to talk to some of the other semiconductor companies at some point. Okay, so I'm going to go here. We're going to go to questions, but here's a request for counseling link. You want to know more about this stuff, request counseling, find a counselor. We'll figure out what you guys need and try to help you out. We counsel by appointment only. Let's go to questions now, Eileen. I'm almost right on.
Sounds good. Let me see. I have a question. Is 6% what the banks are giving for interest rates right now?
It depends. I use 6% as a just as a placeholder. I don't know what the current interest rates are, and a lot of times it's based on your risk profile. So you can't say for sure. You have to actually be evaluated.
Okay. Let me see. They did ask if the slide deck will be available later.
Yes.
Yes. Okay. I'm going to check in the chat now if you have any questions. I don't see any other questions in the chat room. Maybe I missed one.
If we're good, we're good. Let me know.
I think we're good.
Okay. If anybody else wants to ask a question, type it in. We'll give you a minute here. I'll stay on. If not, come see us, and we'll help you out.
Yes, as Lou mentioned, we will be diligently looking at the Q&A for any questions that anyone may.
And there will be an evaluation sent, right?
Yes,
Eileen?
correct.
Okay. If you'll complete it for us, send it back, provide some feedback. We'd certainly appreciate that.
Yes, Anna, you will be receiving the slides in an email that I will be sending once our webinar is over, and then I will be sending a copy of the recording for our program. Any other questions that you may all have?
So again,
great job, Lou.
Thank you very much. I know this was our first time through this. We're going to fine tune it a little bit. I know there was a lot there. There's just a lot involved here. Hopefully this was beneficial. I know someone talking at you for an hour and a half it's hard to maybe to absorb, but again, come back to us if you need additional assistance.
Yes, and if there are any other questions or would like to contact Lou, please send a request for counseling. We can definitely get you your answers to your questions, especially in regards to business counseling.
Okay, Eileen, so you think we should close?
Yes, we're good to go.
Okay, thank you, everybody.
Thank you, everyone.